Two stocks to buy near their 52-week low. This is a video that I do every week talking about stocks trading near their 52-week low. I have two highly requested stocks that I'm going to talk about today. Both of them are trading below 15 times earnings, very hated, bad sentiment, but they have very good fundamentals and highly requested. So I'm going to talk about them and give you my opinion if I believe they're presenting some kind of a generational buying opportunity, or maybe they're just value traps and they will likely keep going lower. So I really hope you enjoy it as always. The first one, highly requested one, is Adobe. Adobe is down 23% year to date. Over the last 5 years, the stock is negative. And I really couldn't believe it, because if you look back at 2021, Adobe was regarded as one of the best high quality stocks. It's an amazing company, recurring revenue software stock. Like, you could buy Adobe 30, 40, 50 PE and it was fairly valued and you can't go wrong, and high margins and all those things about how amazing Adobe is. Well, now Adobe went from 35 PE, and it used to trade around 50 PE, by the way, from 50 PE, now trading at 14.8 times earnings. This is absolutely insane. The kind of sentiment change that happened with Adobe over the last year or even over the last few months, it's been crazy. And the thing with Adobe is, if you look at the revenue growth, it's still at the same pace that it was in 2022. So if the company has faced a deceleration in revenue growth, you're like, okay, that warrants a massive multiple contraction. But we've had a massive multiple contraction despite Adobe being the same company it was back in 2022 when it was trading at 50 times earnings. You look at their cloud business is still rapidly growing, over 24% growth in Document Cloud. Creative Cloud is still growing. Experience Cloud is still growing. The business is still the same. The company has 650 million monthly Acrobat users. Those users are not going anywhere. There's over 3 trillion PDFs all around the world, 400 billion documents opened every single year. I mean, this is a meta kind of reach that they have with Instagram. Adobe kind of has it with the PDF documents. They own the PDF. And this is huge in terms of potential monetization. 650 million monthly active users. Those are still here and they have been growing. So why is Adobe going down? And it's going down because of AI. And so far, AI around the company has been more of a story than actual numbers. Because if you look at the numbers, you don't see the company's fundamentals or the company's revenue or any profit margin or anything deteriorating because of AI. Maybe in the future, but not at the moment. But the company is not sleeping on AI. In fact, they mentioned AI 110 times in their latest earnings report, 110 times. So they're talking about AI a lot. And the company has an AI strategy. They have their existing portfolio, which they have their legacy product, and they're using AI to better those products. They call it AI influenced products, and they generated 3.5 billion in annual run rate with the influenced AI products in 2024. But this year so far, they have generated 5 billion and they have surpassed their full year annual run rate target. We're not even in Q4 of 2025 yet. This is definitely not a dying business. Then they have the new AI first product portfolio where they have AI products and people can use AI with the Adobe AI, 100% AI products. Well, those products have grown from 0 to 125 million, and they expect them to grow to 250 million by the end of 2025. Maybe 250 is not a lot, but this is still a massive improvement from 0, and it shows you that the company is not just sleeping and people and everyone is taking market share from them. They're actually using AI to better their product and to better their offering in general. But looking at Adobe's value proposition, it's trading at 14.8 times forward earnings, and it's expected to keep on growing earnings per share, 12% 2026, 12.5% in 2027. Again, most of their revenues is recurring revenue, subscription-based, 95% is recurring revenue. So a lot of it is predictable, and people haven't been canceling their subscription yet. Adobe is still growing 10%. It's not declining. So I could see the 12, 13% holding up, and you're paying 14 times earnings for such a high margin, predictable business. So I think Adobe is presenting one of the best opportunities in the market and one of the most misunderstood opportunities in the market. And this company believes it's misunderstood, which is why they're using their free cash flow and their cash balance to buy massive quantities of stock, and they reduce their shares outstanding. They will likely continue doing so, and they've been taking advantage of that. So the way I look at it with Adobe, and I used to be bearish on Adobe, by the way. I used to not like the stock, but I'm a fan of any stock if I believe the worst is priced in. And at 14 times earnings, for the kind of sentiment that I'm seeing with Adobe and for the fundamentals, I believe the worst is priced in. And if it comes up that AI is not killing Adobe, or maybe it's not killing Adobe as fast as people believe, I think 14 times earnings will likely end up being cheap, and the stock could potentially recover as the worst is priced in. And once investors realize that it's actually better than we expected, the stock could recover in a major, major way. So I see at least a return close to the earnings per share growth of 12, 13% annual return, but you have a call option with a potential multiple reversion back to maybe 15, 16, 17, 18 times. I'm not expecting Adobe to go back to 30, 35. I think those days are over, but I can see 15, 18, 20 times, which could provide asymmetrical types of returns. So I like Adobe very much over here. The second one is Lululemon, which I told you guys to avoid in my last video. I was bearish on Lululemon, and the stock keeps on going down. It's trading at $167 per share. It's down 55% year to date. Another, terrible story. It was one of the best performing stocks, and now it's down a lot, 55% year to date. Lululemon has beaten their latest earnings expectations, 310 versus 288. They missed on revenues a little bit, but it was not a huge miss. The company has unfortunately lowered their guidance again. They lowered it to 1277 to 1297 versus the estimate of 1445. So this is a massive, massive disappointment. And this is why the stock has tanked. Now, if you look at the company's comp sales, comparable sales, which is a very important metric with retailers and with a lot of those fashion and those kind of cyclical brands, you could say, they used to grow at 30%. It went down to 17, 13, 12, 7, 3%. Now it's at 1%. This is really, really bad, and it's showing massive deterioration. And it doesn't have to do with the economy. It's mainly a Lululemon problem. And I'm not the one saying that. The CEO, he's admitting that himself. And I love the honesty of the CEO, because he said we have become too predictable within our casual offerings and missed on opportunities to create new trends. He is 100% right. He said our lounge and social product offerings have become too stale and have not been resonating with the guest. He's 100% right. There was a lot of new trends like Aloe and a lot of different emerging brands, and they've been taking market share from Lululemon. And that's why I'm not a big fan of investing in such companies, because you never know when the next, some kind of a brand you never heard of is going to take off out of some kind of a random TikTok going viral, maybe tonight, maybe tomorrow night, maybe next week. You really never know. All you need is one TikTok to go viral, and people like copying each other. Everyone wants the same kind of pants, so they go and they buy whatever the influencer is buying, and then you have a new trend, and then Lululemon starts losing market share. Maybe Lululemon has done nothing wrong, but you never really can predict the consumer preference as it changes with whatever, which changes with the wind. It's really hard to, predict those things. And yes, Lululemon does have their loyal customers. They have very high quality stuff relative to other brands, and their pants are very good. But still, I mean, this is the nature of the market, and this is why I'm not a big fan of investing in them. But I think, any investment could be potentially great at the right price. Now, if you look at Lululemon, it's trading at 13.7 times earnings. The company used to trade at 38, 39 times forward. Now it's trading at 13 times forward earnings. This is really cheap for Lululemon, and this is taking into consideration a potential earnings per share decline in 2026. So the 13% forward is based on a 2026 estimate of negative 12%. And after that, the company is expected to regain their growth to 9%, 10%, which I think is fair. And again, the company, just like Adobe, is taking this opportunity to take shares off the market, reduce shares outstanding, do many different things. So the way I look at Lululemon is, yes, the stock is cheap, it looks undervalued, the company is still growing, and it could potentially be offering an opportunity. But I think Lululemon has the potential to be a trap more than something like Adobe, because you can't really predict consumers' preferences. This is something that I'm big on. It's really hard to predict. And I'm personally still not touching Lululemon. Yes, it could have been cheap. And maybe they partner with, I don't know, some kind of a popular celebrity like Crocs has done and others, and they could, or maybe American Eagle has done, and they could maybe take off the brand in a major way. They have the money to do it, they have everything to do it. And maybe it could re-emerge again. 13.7 is cheap, so I'm not saying it's a bad investment. But out of the two, maybe I would personally prefer Adobe. It's not much more expensive than Lululemon, and it's software recurring revenue. So if it was me, I would prefer Adobe. I think Lululemon is not bad over here, but it's definitely not the best opportunity in the market relative to the risks. So that's my opinion on Lululemon and Adobe. Thank you again for watching. Not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.